Camarilla Basics. Now, I thought about how to best present all the information, so I'm going to split it into two videos. One is just the basic rules and a certain rhythm you can follow to take trades with the Camarilla levels. Here are the standard unadulterated rules for Camarilla. The difference between these and the ones I'm going to show you, the only difference is I don't use the levels 1 and 2. I only use 3 to 6 for both the upside and the downside. What that means is I cut away some noise. Here is a daily range of Camarilla levels. For comparison, contrast, here are 3 days of daily levels. These levels are plotted at the beginning of each day, UTC close open. All right. And when they're plotted, you should know these things. H3 and L3, sometimes R3 or S3, depending on your exchange indicator. These are your projected range ceiling, range floor, and oftentimes prices range. These levels help you to make money during a ranging or consolidating market, which oftentimes is very difficult because price isn't always moving. Price isn't always just going straight up or straight down. This is institutional money loves a range. And retail traders love a breakout. You can make money both ways here. So when you see H3 rejected or it passes H3 and then it's lost, that is your cue to short for the other range side, L3, down here. That could be your take profit. You could also hold some to see if the range breaks, or you could try to trade the range again or do both with two different accounts, which is like insurance. If you take an H3 short or an L3 long, trading the range, the floor to the ceiling, ceiling to the floor, your stop loss is going to be on the H4 or the L4 on the same side you took that trade in. So you went long on L3 on these cues, your stop loss is L4. Same with you went short on H3, your stop loss is H4. Because H4 and L4, these are your breakout levels, stop loss levels. If H4 is broken, you get a retest, you get a chance to get in. Your targets are H5, H6. If it breaks L4, your targets are L5, L6. Your stop loss will be, for the breakdown, L3, your range floor, or for breakout, H3, your range ceiling. Fairly simple. Here is some examples. Daily opens, and here I have some ranges, some trades highlighted here. You can see yellow boxes are ranging days, ranging trades. Here you have L3, H3. You have H3 to L3. You have H3 to L3. You have H3 to L3. All right? H3 to L3. Blue boxes are your breakouts. Here, you broke 4. Look, H5. Notice your H3 did not get hit. Your stop loss is safe. All right? H4, breakout to H5. Notice, came close. Your stop loss didn't get hit. Sometimes with the Camarilla system, you really need to trust the stop loss. Sometimes it comes really close. But if it gets hit, you can reassess. Maybe you can re-enter. Or you can wait for the next trade. Either way, this system regularly gives you two great opportunities generally to enter a trade a day. The first opportunity is in the first 3 hours of a market open. That is generally when you see the first H3 or L3 opportunity. And then the second opportunity often comes in the second half of the day when USA open, New York open. You're going to notice that a lot of times you have UTC, you have an opportunity. USA, you have another trade opportunity. UTC, close, you have an opportunity. USA opens, you have another opportunity. Oftentimes you're going to see it play out like that. Another thing you should be aware of when it comes to trading, the range H3 to L3, L3 to H3, usually your first move to L3 or H3, 9 times out of 10, this is from experience, I like to say the first 3 is a lie. Here's an example. Went to L3. Did it break down? Goes to H3. Goes to L3. Did it break down? No. H3 and above and beyond. All right. Day opens, goes down towards the L3. Did it break down? Goes to H3, led to a breakout. Begins the day at H3? No. All right, this here. L3, breakdown, no, goes to H3. And that one was at 2 times. This trade was twice, actually. So this helps you get confirmation to get the ball rolling for your first trade. Oftentimes, the first 3 visited is generally a range reversal trade. And how this helps you, not only as confirmation to get into your first trade early after UTC close, but if the range breaks out, like this day did, you know the first move is a fake most often, and it doesn't hit your stop loss. You get in it, you get to the H3, you take some profit, and that day turns into a breakout day. And where are you? You're in the safest, most optimal place you can be in. You're on the range bottom on the other side as the whole range breaks out to the upside targets. This makes that market maker dynamic that takes advantage of many retail emotions and trading habits. It makes you a part of it, takes advantage of it. You can take advantage of it. You can get in on these trades when you think it's going to the moon, when everyone thinks it's going to the moon or it's going to break down, and very often it doesn't. And you reverse trade it to the direction it's actually going, or to the chop, and you hop along, join the chop. So, more on the Camarilla trading methods in the next video. I hope so far it's been clear. To summarize, you can take a picture of this. 3 to 3 is your range. 4 to 5 and 6 are your breakouts. L4 to L5 and L6, your breakdown. All right, and here you can have the general rules for the stop loss and all of that. All right, more on the next video. Thank you for listening.